Welcome, everyone, and thank you so much for tuning in. We are excited to introduce David Morgan, a fan favorite here at the Money Show Virtual Expo. David researches the economy, stock market behavior, and precious metals, especially silver, and has followed the silver market daily for over 30 years. David, we are looking forward to your insights today. Please feel free to take it from here.
Well, Rena, let me thank you personally for your help and also the Money Show for inviting me. And before I start, we've got about 30 minutes. I want to take about 20 or so. And I hope I generate a lot of questions like last time I was on the Money Show, and just put those into the chat box, and Rena will help me at the end to work through those questions. I may even start a bit early. In other words, I may only go 15 minutes or so. This should generate some questions. So hopefully you're seeing my chart over here, and excuse me as I don't look at the camera. I look at my other screen. I use two monitors, as most of us do. So you can see on the risk versus return ratio here what we have. And this is from BMG Group, Nick Barishev. He and I have been friends for years and years and years. He introduced himself, I think, right after he started the fund. It's Canadian based. It's bullion only. They have a few funds, but the prime one is bullion only. So here you see the risk and the return, and you look at gold, and the risk is very much to the left side, meaning low risk. And the return is as good as or better than, and this is to 2015, so it would change. But the general idea is gold outperformed McDonald's, Exxon, Johnson & Johnson, the Dow Index, IBM. And when they get out to IBM as an example, your risk in that stock is around a 6, and gold again is closer to 1. So what is the Sharpe's ratio? I don't have time to explain it. I don't want to mis-explain it. You can look it up on Google and read about it, but it talks about probability. And when I wrote the Silver Manifesto with Chris Marchese, I used the Sharpe's ratio to prove beyond a shadow of a doubt that the silver market is manipulated. And that's based on what the Sharpe ratio identifies. In other words, it's outside the realm of natural law that you could have a certain open in London and a certain close in New York the same multiple times. So anyway, again, if you're interested, you can go through it. Now, some of these charts I downloaded for this presentation, and a quick review. I did not get what I wanted out of them. Okay, I got it. I don't want to leave the meeting. So excuse me as I bring up a browser here real quick. And I want to bring up the exterior pyramid. And I should get it pretty quick. There are several of these. So this is a very good representation of the financial system. And this was produced by John Exter, who was a member of the Federal Reserve Board way back when. He's been deceased for years and years and years, but he was considered a gold bug based on monetary history and his own belief system. So this is an upside down pyramid. Some of you are familiar with this, some of you may not be. But if you look at this upside down pyramid, what it shows, and this is a good, again, metaphor of the monetary system or the financial system, really. So a pyramid is the most stable structure on the planet. So an upside down pyramid, the way our system is built, implies it's very unstable, and it is. So what it shows, if you look at the left-hand side, the arrow going up, it says higher risk of default. So as you go up the pyramid from gold at the bottom to derivatives and unfunded government liabilities at the top, the higher risks of default. In other words, we all know, anyone on this lecture should know, that it is impossible to pay back the unfunded government liabilities of the United States. In other words, all the military pensions, all the government workers' retirement, all the Medicare, Medicaid, Social Security, all that going in the future, it's impossible to pay back in real terms, impossible. Now, in funny money terms, you can print it up and you can give it out and you can satisfy the nominal value. So let's say your pension was $2,800 a month. You may get $2,800 a month 10 years from now, but that $2,800 10 years from now may be worth $2.80 as of 10 years previous. So I think everyone understands that. So if you take a look at the right-hand pyramid coming down, it says lower risks default. Gold has zero risk of default if you own it in physical form. When you own an ounce of gold or half an ounce or 100 ounces, be it in a bar or a coin or even in artwork for that matter, or jewelry, gold is gold is gold. It's all equates to the same as long as it's the same purity. In other words, 999 fine. And it can't default if you hold it. So that's the ultimate. Now, I would put silver at the very tip of the pyramid because there's less silver in investment form or in that pure form or monetary form than there is gold, believe it or not. Most gold retains its monetary form, whereas over half of the silver market does not remain in monetary form. It's in your cell phone, your laptop, your flat screen, your membrane switch, and all of that. So above gold, risk of default is paper money. Physical money or paper, what we're talking about here. I mean, once you have, that Zimbabwe dollar, or, in this case, 50 trillion of them, it's not going to default. Not might be worth much, but it's going to not default. You own it. And this is something I will be lecturing on Greg Hunter later on in probably my next USA Watchdog interview. I'll be talking about the ownership theory of money, which is extremely important. And I don't think anyone's talked about it in probably 40 years. Coming up from that, of course, is your government bond and your treasury bills. And this is where it starts to get interesting, because going back to what I said about the liabilities, the unfunded liabilities, the government can always meet the interest payment on their debt by printing more money and handing it out. But what is it worth? In other words, if you don't trust a dollar today, why would you trust a note for 6 months or the 10-year benchmark for 10 years? You wouldn't. And I don't think anyone that's sophisticated in the bond market doesn't understand what I just said, but they're still willing to play the game because they're sure that it's so deep and wide and that there's always another buyer out there if you want to sell. That may not be true. Then, of course, your corporate and municipal bonds, and then your non-money monetary commodities, private businesses, real estate, and all that. So you all get that. And of course, there's subdivisions I won't go into. I mean, some paid off, real estate, residential, people have to live. It's in a community where it's a good economy. That might be, should be maybe lower risk down this pyramid. So I don't want to get into minutia, but generally speaking, this is an accurate representation. So let me go back to the desktop. I had a few more, but they don't show up. So let me try this one. It doesn't, blanks out. So this one was gold versus, that one that just blanked out was gold versus Berkshire Hathaway, and actually gold outperformed Berkshire Hathaway from given time frame of the beginning of the gold market from 2000 through, I think this chart went to 2018. So gold, the most important statement I can make, and I can't show you the chart, even though I tried to get it before this lecture, but I was a little late in asking for it, was gold's performance from the inception. Now, the title of this lecture is, is gold a short-term fix or a long-term solution? And the idea is it's a long-term solution. So forgive this corny way of doing it, but that chart, if you could get a general idea of it, shows three things. It shows gold's performance, it shows the S&P 500 performance, and it shows a bond index performance. And from that chart, you can see that gold has outperformed all of them.
I stopped your screen share so they could see it bigger if you want to hold it back up.
Okay, sorry. That's so that shows gold, the S&P, and a bond fund, and gold has outperformed all of them. So on that time basis. So if gold is designed or meant, or known is probably a better word, to preserve your wealth, it's done that. From the bottom of 2000 until 2020, it's compounded at an annual compounded growth rate of 10%, which means that you have kept really above the true inflation rate by owning gold. Gold is not designed to do much more than preserve your wealth. So the dollar that you held 20 years ago was worth the same value 20 years later, and it's done that. In fact, it's actually outperformed slightly based on the numbers, and I don't want to get too involved here because there's always arguments, but if you use shadowstats.com, my friend John Williams, he says that we've generally had inflation, true inflation, of about 9% over that 20-year period, and gold is compounded at 10%. So it stayed above the inflation rate. It's definitely maintained your purchasing power. Silver actually has not performed as well as gold, although it depends what sector you take or what metrics you use. You can pick and choose and make it look better by saying, well, in this 5-year period, silver outperformed gold or something like that. But using the same metric over 20 years, silver has compounded at 9%. So it's stayed even with inflation. So as many ups and downs and disappointments that silver investors have had from a long-term perspective, it too has basically done its job, which is not only to preserve wealth, but usually or can in a inflationary environment, generally speaking, make you wealthy or help your wealth to multiply. But that's, and I'll talk about that here for a moment because there's still the big inflation deflation debate. And it's still, school's still out on it. I mean, I am kind of neutral. I like to use stagflation because it kind of lets me off the hook. Things that you need will continue to go up in price, which means, energy, food, housing for the most part, depends where you are, and that may ebb and flow. I think we're going to have a real estate pullback here in the US fairly shortly. But things that you don't need will probably come down in price, 72-inch or 85-inch or 98-inch or whatever the heck these big screen TVs are, just don't have the same market that food does. Food is a necessity, a big screen or bigger big screen is not a necessity. So those type of things will start losing market share because people only have so much disposable income. And as the economy contracts and money becomes worth less and less, then the spending goes into necessities rather than nice to have stuff. So I think I have taken care of that. And I don't know how far we are in the sea. So 20, 30, so I'm about halfway through, 12 minutes. So I'm just going to flip through these charts and look you in the eye. I think one of the things that is important in this chart book, and this chart book is made for money managers, by the way. It's for people that are responsible for other people's wealth, and people that have a money manager or a wealth manager usually have saved a substantial amount looking for retirement or a legacy or whatever. So one of these charts I think is important is the largest central bank holdings of gold by country in 2020. This chart book has been published very recently, by the way. So the United States holds the largest amount of gold central bank wise. The next is Germany, and then followed by Italy, France, Russia, and China. And all those four are about the same amount of gold. And then it drops down Switzerland, Japan, and India. Canada is basically at zero. And that's pretty interesting. You notice I didn't even mention the United Kingdom. So this is what's purportedly held. I'm not sure all that gold in Fort Knox is there, but I don't have time to go into the whys and the wherefores of that. Gold in various currencies is another thing that I think a lot of people really don't think that much about. So for example, silver in 2020 had the greatest investment demand it's ever had in modern times. The amount of silver demand in 2020, this is in the record books, this is fact, this isn't wishful thinking on my part, this is an exact number based on the best studies in the silver market. There was roughly, round numbers, 200 million ounces of silver in the retail market demanded in 2020. And there was over 300 million ounces by the ETFs, or what's called ETPs, exchange traded products. So if you add the 2 and 3 together, you get over 500 million ounces of silver for investment demand in 2020. That is far and above anything that we've seen for probably forever. And yet silver did okay during 2020. I mean, we saw the big dip down to 12 in March, and we saw it kind of rocket up into the 28, almost 30 level. But a lot of people say, well, why didn't it go higher, and on and on? Well, it has to do partly with the currency mechanism that I call the banker's last vestige of hope, training everybody to think of their net worth in currency terms rather than, let's say, gold terms or silver terms. So in India, silver was at an all-time high basis the rupee, or their currency. So it'd be like hitting an all-time high in Canada or the United States. If silver was, let's say, at $150 US, there'd be a lot of motivation to sell it. It was at a profit, and I'm going to sell that stuff. I held it for X amount of years, kind of tired. I can't take the volatility. Look, it's at that price. So a great deal of the silver that kept the market from going even higher than it did is the fact that, one, the illness caused a big contraction in their economy, just like everywhere in the world. On top of that, it was an all-time high in currency. So a lot of people sold it because they needed it. That was their savings. That's how a lot of the people in India save, is in gold and silver particularly. It used to be silver more than gold, although their economy's gotten bigger and better. And so there's more gold purchases than there used to be. Regardless, a lot of silver was sold in India. And of course, that is a world market, and it gets, refined or re-refined into, commercial bars or whatever the demand is. So that is something that really hasn't been pointed out, I don't think, very much. A lot of people ask, well, that question. I mean, gosh, there's that much demand, wouldn't it be even higher than 30? The answer is yes. If India's demand was commensurate with what they usually have on average, it certainly would have been. But since they fed a lot of that silver into the market because it was so high, record high in their currency. So I beat that one to death. I don't have much else to show. I think one of the biggest questions I get and is not well understood, from my opinion, and that's, well, the FOMC meeting did this and gold sold off, or the bankers had this and the gold sold off, or the Fed just met and gold sold off. That is hyperbole for the most part. Most people won't believe that when I say it, but the best book on that is written by Robert Prechter on socioeconomics, and he proves to me, at least, beyond a shadow of a doubt, that everyone's looking for the why, and the why is always based on the news, but it really isn't. The reason that a market goes up or down is there's buying pressure or selling pressure. And the selling pressure in the metals comes from the bullion banks, and they sell whenever they feel like they want to take the price down, more or less. That's a kind of a generalized statement, but it's fairly accurate. Is it precise? No, but it's generally true. And then there's always something that they tag along with it. Now, is it timed or is it coincidence? I'll leave that to the viewer. You can decide for yourself, but there always seems to be a correspondence to some Fed meeting or FOMC or G7 or G20 or whatever when these sell-offs occur. But nonetheless, that's really a cover story. And also it's training. It's training the public and the financial markets, even well-established brokers and people you would consider to be very studied in these markets and all that. But if you really break it out objectively and take a hard look at the data, you're going to find out it's more or less a bluff. Do markets move on the news? Sure they do, but not nearly to the one-to-one correspondence that you're taught, not even close. In fact, one of the best movers in true news moving a market is the junior gold sector, where a huge discovery will move the stock almost every time. And that's a reason to move it. Whereas a lot of this stuff is just, let's say, well-timed coincidences. So Rena, I think I'll leave it there. I'm not sure how much time I have left. I know I've taken well over 2/3 of the time. So if you've got any questions for me, I'm happy to start in on them.
Yeah, absolutely. We have about 10 minutes for questions, so we are all good. All right. The first one is, in your view, what percentage of precious metals portfolios should be allocated to physical precious metals? And is there a reasonable distribution among gold, silver, and platinum?
Yeah, that's an excellent question. I can tell they're not a member of the Morgan Report, and that's fine. Really, it is. So when you become a member, there's a PDF file called How to Use the Morgan Report. And the first question I address is that one. And I'm happy to do it here. So I'm fairly conservative. I think most people recognize that. And I've said pretty much from the beginning, in fact, it's written in a book, how much allocation do you have to precious metals? And in that book, I wrote 10%. And then during the Iraq situation years and years ago, I said, I think 20% is more fitting under the current economic conditions. But let's just go with 10%. So I'm giving you guidance. I'm not giving you exact, but this guidance I think applies, and it does answer the question just asked. So if you've got $1 million savings, and that's what you have for a portfolio, and I like to look at it outside of real estate. So out of that $1 million, 10% of that would be 100,000. And then that 100,000, I would say, depending on your age. So it goes into this in the Morgan Report. I'm doing this from memory, but the idea is sound. I wrote it. If you're like 50 and up, so 50, 55, 60, 65, 70, probably 50% would be in physical metal. Now, if you're younger, you could have less, like 40% or 30% or 20% be about my minimum. And now gold to silver. So if you're above 50, maybe half is in physical. And gold is weighted more and more the older you get. And the old adage for a bond investor was if you're 70 years old, 70% went into the bond market and 30% went in equities. Sort of the same thing in the gold silver ratio. If you're 70 years old, you probably have 70% in gold and 30% in silver. If you're 50 years old, it could be 50-50. If you're 60 years old, 60-40, that kind of thing. The reason being is that gold does what it's supposed to do. As I started this lecture, it preserves your wealth. It's almost guaranteed to do it through all economic conditions, inflation, deflation, stagflation, whatever combination or whatever twist you want to put on it, gold will do its job. Silver, not so much, depending on the economic conditions, although in an inflation, it can outperform everything. And then the remainder goes into stocks, and I break that down. So I do like 80% in the top tier, cash rich, unhedged mining companies. For the most part, are royalty companies. We've left some of the royalty stocks are still in the portfolio from the inception, and some we've let go and put in with other stocks. So that's big money goes into big companies. Mid money goes into your mid-tier stocks that are my favorite profile, which means they're producers, but they have a lot of exploration potential to add to their production base, or maybe have other properties in other jurisdictions, or are in the same jurisdiction but in other areas that haven't been explored yet. So you got a lot of sweetener to an ongoing producing company. And then lastly, we have rank speculations. Like everybody, if you're interested in one that I own, it's called EnviroLeach Technologies. It's been all over the map. The symbol is ETI on the Canadian exchange, not on the Vancouver, although they just upgraded their listing. So maybe on the Vancouver, I'm not sure what exchange it's on now. But if you just type in EnviroLeach, and it actually changed its name recently to Envirometal. So I think if you typed in ENVIROMETAL, Envirometal, I own it. I'm biased. It's a game changer in my view. It's probably, in fact, one of the most important things to happen in mining in a very, very long time. But as a micro cap company, it's bet a little to win a lot. I tell the speculative folks to, only bet money they can afford to lose. And if and only if these companies come to fruition, then you can add more money to your initial bet. Ready, Rena, for the next one?
Awesome. Thank you. All right. I'm going to summarize about 5 questions here. And let's just say what is your, look into your crystal ball. What is your short term and, 1 to 2 year forecast for gold and silver prices?
Still convinced that we're in the last phase of the bull market. Short term, I think we're going to end in the end of August. I think after Labor Day, we'll start an uptrend again. I'm still looking for all-time nominal highs in both gold and silver 2 to 3 years out. I think silver will finally break through the $50 nominal level 2 or 3 years out. And I don't know how high is high. Is it 100? I've always said it would get there. It said we see triple digits, so I'll stick to that as a minimum. And then gold, I mean, there's a lot of advocates and gold students that are looking for 3,000, 5,000. I think 5,000 is pretty reasonable. And those, I think, are actually fairly modest numbers, believe it or not, based on the amount of currency that's been printed and is failing. So thanks for summarizing those. That's what I'd like you to give me the questions.
That's what I'm here for. All right, this one's a little long. Today, the US Mint sale of 200,000 proof silver eagles sold out in 2 minutes, yet silver had one of its worst weeks ever. There's a complete disconnect of macro indicators and the performance of the market indicative of paper manipulation. How long can this continue?
Until it ends, but just to try to be objective here, that number sounds big to an individual investor, but it's a spit in the ocean, excuse the crude analogy, relative to the size of the silver market. I mean, the silver market's a billion ounce market every year, 850 million ounces mined with 150, at least 150 million ounces recycled for a total 1 billion. So if you take that number and divide it into 1 billion, you'll see that the disconnect isn't the fact that it's sold out, because those are coin collectors. I mean, those are absolutely smart buys in my view. And I'm not a coin guy, but I'm smart enough to know when there is a very limited edition, so small mintage, and it's a change in the way of the coin itself. So it's like a typeset that changes. I mean, those are anybody with any coin familiarity would gobble those up almost regardless of price, because in the next few years they'll be worth probably almost, they will appreciate. Yeah, but when will it end? I mean, we're all tired of it. I mean, yours truly. I mean, look, I've been in this a long time, longer than probably most of you viewing this. But, I feel it will. In fact, all manipulations end. I mean, if you go back, and I'm old enough to look at, what happened in the London gold pool, and there were people just as discouraged at that time, like, look, these governments have colluded together to sell gold, keep selling gold and keep selling gold at a fixed price and make sure that all these gold bugs go away and leave them alone. But the London gold pool eventually failed, and the silver and gold manipulations will as well.
Awesome, thanks. All right. In your opinion, what impact will electric vehicles have on silver prices?
It'll help move them up. I did a write-up for the paid people, the premium service that I have. I interviewed Mike Watson. You can look him up and ferret out some of this information for free. And he's projecting over the next decade that the amount of silver use in industry will be 80%. And right now it's 50%. So in the next 10 years or 9 years, really, you're looking at an increase in the silver demand that's almost off the charts. A lot of it isn't electric vehicles. It has to do with, fabric-based silver solutions. Like you could put it into clothing, or you could put it into paper where it's bendable. A lot of electronics are going to be needed to be used in that manner, where there's flexibility to the process. I could use like solar, let's say with the solar shingles, they've got to have some flex. I mean, I know solar panels don't, but there's applications where you'd really want it to have that. So there's a lot of that will be coming into the silver market as far as industrial applications over the next decade or so.
That's so interesting. Thanks. And then we have time for one more. How about, in your opinion, what are your thoughts on Bitcoin? Is it the new gold?
Well, I think the best thing I can do, look up my article. It's called My 2 Bits About Bitcoin by David Morgan. I will repeat that. My 2 Bits About Bitcoin by David Morgan. It's on my blog. You couldn't find it on the blog without going to a search engine. And it goes through my whole thing. Look, if I say who, starts off, if I am who I say I am and I'm free market, who cares what I think? The market knows more than me. The market will determine. But the bottom line is, if it does become a competition to the money powers, the money elite, and they see it as a threat, watch out, because they don't want to lose their monopoly. So you could see regulations. I'm not sure I use the word regulations, but you get the gist. That's what I wrote it. In fact, I just reread it a while back, and excuse my ego, I was actually fairly proud of what I'd written in 2014 relative to where we are now. That was 7 years, and my look ahead was pretty accurate. So if that's what I think, I haven't changed. If you want Bitcoin, knock yourself out. Is it the next gold? No, it is not. Do a thought experiment. Turn off all the electric power and ask yourself if you want a Bitcoin or an ounce of gold.
I did find that article and I did post it in the chat so they could click it
Oh,
easily.
thank you. You're so good to me.
Thank you.
Thank you.
And then one last thing, someone's asking that, just to reiterate the name of the investment that you were talking about. I think like 2 questions.
Sorry for the confusion. It's changed exchanges and it's changed its name. So it's Envirometal, ENVIROMETAL. And if that doesn't come up on a search engine, then type in the old name, which will be EnviroLeach, which is ENVIROLEACH. Between those two names in a good search engine, you ought to be able to find the company website. Yes, I own the stock. Did I overinvest in a speculation? Yes, I did. Did I invest more than enough that will hurt me? No, I didn't. So that's kind of the approach. I do think it's a phenomenal change for the industry, and it's very green, green, green. What we have done is got a reagent that is inert. You can actually drink this stuff and it precipitates out almost all the metals. So it's the best e-waste leaching process available. And it's something that I think is worth the speculation. So thanks for re-asking, Rena.
Yeah, of course. And I did find that one as well. And I put a link in the chat too. Awesome. Well, that's all we have time for today, David. But thank you so much for a phenomenal presentation and for joining us. We always appreciate you being here.
That's always fun. Thanks.
You're welcome. You have an awesome rest of your day. Okay.
I will.
Thanks.